Thanks very much. Morning, everybody, and welcome to today's presentation. Just to let you know, there is a feedback form which I've just put in the chat box, which we would be very grateful if you could find time to complete. It's only a few questions at the end of the presentation. It just gives us obviously some feedback about the session and lets us know whether or not we're aiming, if we're pitching it at the right level, should I say. Okay, so let's get started. So who are we? So Money Helper, we are now an amalgamation of three organisations that we previously known separately. So we were the Pensions Advisory Service, the Money Advisory Service, and PensionWise. And we're all now just known as Money Helper, although all of the same services do apply. So what we do is we provide independent, impartial information and guidance to members of the public about all matter of all subject matter to do with finance and money. And we do have a dedicated pensions team, because obviously pensions is quite a specialist area. We can also point you in the direction of other trusted services if you need support from us. So there's just a little bit about what we do. So we help people with debts, reducing spending, making the most of their income. Very, very topical at this moment in time. Anything from supporting loved ones, so elderly parents, as we all get a bit older, planning for major purchases, so mortgages, for example, and finding out about benefits, and of course savings and pensions. And we have various lines of communication. We have helplines, we have web chat services for both sides of the organisation, so money and pensions. And also you can also put written inquiries on our websites if you want a formal written response to your query. So as I said before, we offer information and guidance. What we don't do is offer advice, either financial advice or, of course, legal advice. The simple reasons that we're not authorised or regulated to do so. So the way to look at it really is that what we do is we explain to you how things work and what you can do. What we cannot do is tell you what we think is in your best interest or make recommendations to you. If that's what you're looking for, then you would need to seek either financial or legal advice. So in a little link here on these two slides, you will see we have a directory on our website that will point you in the direction of regulated financial advisors, although again, there's no recommendations made. And if you need to find a solicitor, then you can use a link below to the Law Society website that will help you find a solicitor in your area that works in the practice area that you're looking for as well. So what I'm going to talk about today, so we're going to look at how much money you need in retirement. Obviously, a very difficult question. It's very difficult to predict the future, but there are some tools that you can use that will provide you with a good guide to where you are and where you think you need to be. We'll also be looking at how menopause can affect your pension in more surprising ways than you would imagine, I would guess. Why is it important to look after your pension? The different types of pensions that there are, and then we'll specifically look at the NHS pension scheme, the different sections and how they work. We'll be looking at flexible and early retirement, the contribution rate changes that are due to come in. Not a very pleasant subject, but what always goes with pensions is, of course, death benefits. So we'll be looking at what would happen to your pension benefits in the event of your death, how you can save more into your pension scheme. We'll also be looking at pension scams and how to spot them. Unfortunately, pension scams are very much on the increase. So we'll be talking about those very briefly. We'll be talking about your next steps, what you can do now to plan for your future. And then we will have some information at the end of the presentation about how you can contact us for further information. So why is menopause and pensions even a subject? Well, for the simple matter that's in the box on the right-hand side, apparently almost 1 million women are retiring early due to menopause symptoms, which may or may not be in their best interest, which is where the concern arises. So typically women have lower pensions than men in any event for many reasons, including it's often women that bring up children, care for elderly relatives, And of course, many women work part-time as well. So for all of those reasons, women tend to have less retirement savings than men in any event. And then, of course, retiring early can have a significant impact on that. So how much money will you need in retirement? As I said before, this is a really, really difficult question because none of us can predict the future, and it all depends on your your particular financial circumstances and of course your lifestyle. However, there are several guides that you can use. So one really good one, and this is where this box on the slide is taken from, there's a website called Retirement Living Standards, and what this does is it sets out minimum, moderate and comfortable lifestyles for single people and couples, and it gives you a rough idea of what you would be looking at for your very, very basic needs. Of course, this will massively depend again on your personal circumstances. So whether you've still got a mortgage, whether you're paying rent, and the lifestyle that that you're wanting to achieve. So as you'll see at the bottom of the slide, sorry, at the bottom of the box, should I say, it also tells you what the full state pension is. And as you will see quite clearly from that, even for a single person, the state pension is not going to cover even your very, very basic needs. So you do need other pension provisions other than the state pension. We also have several calculators on our website that you might want to have a look at. So what these will do is help you figure out your budgeting, so what your spending is likely to be. Again, it will help you figure out what sort of income you might need in retirement, but also critically, it will tell you where you currently are. So you can put all your pension savings into it, and it will tell you if there is a gap between what you want to achieve and what you're in line to achieve. And if there is, it will give you some indication of what you need to do to bridge that gap before retirement. So how can the menopause affect your pension? Well, several ways. Menopause symptoms might make you think about changing your work pattern, or indeed whether or not you carry on working at all. So you might want to consider early retirement. You might consider partial retirement, so cutting your hours back, for example, possibly changing a role, doing something less stressful or less physical. Not applying for a promotion that previously you may well have gone for, moving away from your current role to do agency work or bank work, or moving away from your current role to become self-employed, for example. Your decision might be affected by brain fog, anxiety, exhaustion. So although it's very tempting if you're suffering from menopause symptoms to think about finishing work early, it does need to be carefully considered in the light that your decision might be affected by any of those factors. And of course, it's a permanent decision once you take it. But on that note, I will hand over to my colleague, Janice.
Thanks, Donna. So we're going to look at now, why is it important to look after your pension? Well, you could see on the slide that Donna showed you with the figures about what retirement might look like in terms of cost, that the state pension itself is not likely to be enough for most people. Where, for most people, we're hoping to have more than £9,500 a year to live on. And that's where private pensions and workplace pensions can come into their own and help provide that additional income to help give you that level of income that you're looking to have. So the state pension age is currently rising. So at the moment, you can get your state pension from 66. Shortly, that will be rising to 67. And then for people who were born from 1978 onwards, they will find that they won't be able to get their state pension until they're 68. So that's mostly people who are born, who are in their 30s. So that can have an impact on people's planning for retirement, and your normal pensions with workplaces and private pensions, they can be accessed much earlier than your state pension. So at the moment, a workplace or private pension can be accessed from the age of 55. That will be going up to 57 in 2028. And then thereafter, they're looking at making it 10 years below your state pension. So that's 10 years where your state pension, your private or workplace pensions would need to support you until your state pension comes into play. So this is why looking after workplace or private pensions can be so important. Now, not only that, but with a workplace pension, you also get free money, both in terms of tax relief. So that's money that would have ordinarily gone to the government as tax is going into your pension instead. So that's making pensions a tax efficient way of saving. But also you get that free money from your employer. So if you weren't in the pension scheme, it would be money that you wouldn't get. So with your employer, they pay just over 20% into your pension on top of the contributions that you make. So that does help boost your pensions. Also, when you come to take your pension, you could get a tax-free lump sum of 25% of your pension. Now, think of all the things you could do with that 25%. It could pay the last bit of the mortgage off, do the home improvements you've always wanted to do, maybe help the kids with getting on the property ladder or university costs. There's lots of different things people would use that money for. And also there's the benefit of it being completely tax-free. That's always a good benefit. Okay, so what types of pensions will you come across? Well, first of all, there is the defined benefit style of pension, and this can also be known as final salary or care scheme. Now, final salary and care is not a type of pension, it's the way in which defined benefit schemes are calculated. But if you go to a pensions administrator and say you're a member of a final salary or care scheme, they will know what you mean. So it's something you can use as a terminology. Now, what does that type of scheme offer you? Well, it gives you a guaranteed form of income for life. It is classed as the gold standard of pensions because of this guaranteed nature of them. Now, why is it called defined benefit? Well, it's called defined benefit because the income that you get from it is defined by the calculations in the scheme rules. Once you've paid those contributions, it's up to then the scheme to ensure that there is enough money in that pot to pay your benefits. And then you have the choice about how you take that money out. So you could take it out and just have just a pension, or you could take it out and have a tax-free cash plus a smaller pension, or you could have somewhere in the middle of that. Now, you can start accessing it from 55, but these types of pensions are likely to be reduced if you do take them early. So it is important to understand what that impact could be for your pensions. And that's where asking providers for quotations, showing you what you would get at your early retirement age that you're looking at doing, and the normal age can come in useful. If you do want more information about defined benefit schemes, you can see there on the slide that if you click on the word here, it will take you to our website where there's more information, and these slides are going to be made available at the end of the presentation, so you'll have access to all these links as well. Now, the second type of pension is known as a defined contribution style of pension, or DC, or money purchase style of pension. Now, this is a very different kettle of fish to defined benefit, because this is a pot of money that's been built up based on the amount of contributions that are paid in, the level of investment that's happening, and the fees that are being deducted. And with this type of pension, you don't have that same guarantee of what you will get at the end. It's based on those three things that I've mentioned. So it does give you more flexibility with regards to how you can take it, but it doesn't offer you the same guaranteed form of income that a defined benefit scheme does. Now, within the NHS pension scheme, you may come across this term if you pay additional benefits into your pension through what is known as the money purchase additional voluntary contributions, or money purchase AVCs. And we're going to talk a bit more about them later on in the presentation. But with regards to how you can take this type of pension, you will still get that 25% tax-free cash, but then you have a range of flexible options available to you that range from leaving the money where it is until you do need to take it, to having it as a regular form of income, to having flexible ways to take it where you control how you do that, to taking it all out in one lump sum, to doing a mixture of those. So you can see there's a wider range of availability to you with regards to taking it. Now, the bottom link, the bottom here, where you can click on, that'll take you to a page on our website that will explain more about defined contribution schemes. But if you wanted to explore those options, say you did have a defined contribution scheme from either another employer, or you did do the money purchase AVCs within the NHS scheme, and you wanted to explore those options a bit more, there is a section on our website called Pension Wise, and within that area you will find information about all those different options. So if you want to have a look at that, please do. if you don't mind, Donna. Yeah, so what we'll do now is we'll have a look at the NHS pension scheme itself. Now, with the NHS pension scheme, it has 3 separate sections. Now, you can be a member of more than one of the sections. It depends on when you joined the NHS. So if you joined the NHS before the 1st of April 2008, what you may find is that you've got benefits within the 1995 section. So with this one, it's a final salary pension, and that means that you build up a pension worth 1/80th of your salary for each year that you're a member of the scheme. That's what the accrual rate is. It's building up your pension. Now, with this section, for some people, they have a non-retirement age of 60. For some, they have a non-retirement age of 55. And for people who joined before the 6th of April 2006 and met certain conditions, they have a normal retirement age of 50. Now, if you're not sure what your normal retirement age is and you're a member of the 95 section, have a look at your total reward statement. If that's not clear or you're still not sure, then do speak to the NHS providers. They will be able to confirm what your normal retirement age is. Now, as well as having a pension within the 95 section, you do also get an automatic tax-free lump sum of 3 times the annual pension that you've been calculated. If you wanted more than that automatic tax-free lump sum, you can give up some of your pension to have a bigger tax-free lump sum. So that's a little bit of that, the 95 section. Now, the next section you could be a member of is the 2008 section. Now, this is for people who joined between the 1st of April 2008 and the 31st of March 2015. Now, again, this is a final salary section, but this time the accrual rate is 1/60th. So that means you build up 1/60th of your salary for each year you're a member of it. Now, with this one, you don't get the automatic tax-free lump sum, but you can exchange some of your pension for a lump sum. This time, with the 2008 section, your normal retirement age is 65, but you can take your pension from the age of 55, but it will be reduced to take that into account. And then for people who joined since the 1st of April 2015, they will be members of the 2015 section. Now, this is a career average or care scheme, and this works differently, and Donna's going to explain how this works shortly. But it does build up a pension, but it looks at your salary each year. So it does 1/54th of each year's salary. So instead of looking at your final salary, it looks at each year's salary. Now with this one, again, you can exchange some of your pension for a tax-free lump sum. But this time with the retirement age, it's now linked to your state pension age. So if your state pension age is 66, your normal pension age for the scheme will be 66. But if your state pension age is 68, your normal pension age for the scheme will be 68. But again, you can take your benefits from the 2015 section from the age of 55, but they will be reduced to take into account the fact that you're taking them earlier. Now, as I said earlier, you can be a member of more than one of the sections. So your total reward statement again should show you which sections you may be a member of. And because they all work slightly differently, it is just important to bear that in mind. Now, you may all have come across something called the McLeod judgment, and it is quite a complex area. But effectively what this is where 2014 there was a report done, and what the reports recommended was that the calculation basis for public sector schemes was changed from the final salary method to the career averaged method. So that's what happened. They did that. But what they also did at the same time is offer something called transitional protection for those who were close to retirement. However, that was challenged. And what the court said was that it was actually discriminatory on grounds of age. So what they have now done is they are working to correct that. But what is important to remember with this this change that happened, it happened across all public sector schemes. So trying to correct this is a massive exercise for everybody to do. Now, the NHS are currently working on theirs, and it won't be in place until October 2023. But at the moment, what they've done is from April this year, they've put everybody into the 2015 scheme, irrespective of age. Now, it's not something you need to do anything about. It's all being done for you. So if you were a member of the NHS pension on the 31st of March 2012, and you were then still a member on or after the 1st of April 2015, so you have continuous service, then when your benefits come payable, you'll be offered a choice of receiving your benefits through the old legacy scheme, so that's the final salary benefits, or through the 2015 care benefits. So they'll offer you a choice of which way you want it to be calculated. But as I said, that won't be in place till 2023. Okay, now we do know that a lot of people will have questions about this, if you don't mind, Donna. And it isn't something that you need to think about affecting your retirement for. All this will be done in the background for you by the administrators. So if you were thinking about changing your retirement date because of them, any changes that might happen to your benefits, that will be dealt with retrospectively if you've already retired, or they will deal with it as and when you're looking to retire. Now, you do still retain any links that you have with the 95 and 2008 sections, so your benefits within them will stay the same, and any normal retirement ages within them, those will stay the same. It's only the benefits that you built up between April 15 and March 2022, where you're going to have that choice between final salary and care for the calculation. Now, one thing you may have noticed is that at the moment your total reward statements are still showing the pre-McLeod judgment. That's because everything is still in process. They're still getting everything ready because it is a huge exercise for them. So that will be sorted out and you will eventually see that change. But if you do choose to retire before October 2023, you will get a retrospective choice with regards to your benefits. Now, it is quite a complex area, as I say, so there is lots of information out there with regards to how all this works. In the green box, you'll see that there's two links. One to the NHS website, where there's information about the McLeod judgment, and the other to the gov.uk website, so you can have a look at those bits of information, and they'll just give you a bit of further clarification on how all this works. Okay. Thank you, Donna. So what we're going to do now is we're going to have a little look at how a final salary scheme works. So what you're doing with a final salary scheme is you're building up an amount of pension per year that you are a member of the scheme. So if you work full time, you build up 1 year of pensionable service for each year that you work. If you're part-time, then your pensionable service is prorated because you are part-time. When you then choose to leave the scheme, the amount of pensionable service is multiplied by your final pensionable salary, and then it's divided by the accrual rate to get the pension payable at your normal retirement age. Now, one thing I will say with regards to final pensionable salary, that can be different dependent on the section of scheme that you're in, but it can also be different depending on the type of final salary scheme that you're in. So with final pensionable salary and the definition, it's always important to go back to the administrator for that particular final salary scheme and ask them for the definition. The NHS Pension does have a really good website and they've got lots of guides on there, so you could always have a look at there. I know there is one particular guide on that website that does explain what the definition of final pensionable salary is for each of the different sections. So that could be a useful tool for understanding what your definition is. Now, what we're going to do now is just have a quick look at a very simple example of how, sorry, Donna, if you just go back a second. Thank you. Of how the final salary scheme calculation works. So we're going to have a little look at Lisa, and she's decided to retire at the age of 60 after having done 25 years of service. And when she leaves, she's got a final pensionable salary of £40,000 a year. Now, the 95 section has an accrual rate of 80ths. So Lisa's calculation is very straightforward. It's 25 years times by her salary of 40,000 divided by 80. Now, that then gives Lisa a pension of £12,500 per year. Lisa then also gets an automatic tax-free lump sum of 3 times 12,500, which is 37,500. But if Lisa wanted to have more than £37,500 of tax-free cash, she can give up some of that pension to have that higher tax-free cash. Now, the rule of thumb is that for every £1 of pension you give up, you get an extra £12 of lump sum. But it is important to think about the effect that that has on the annual pension that you'll get, and think about how that'll affect your standard of lifestyle going forward. A lump sum is nice, but that might be something that only lasts a specific amount of time, dependent on what you're wanting to do with it. The pension is there to provide your lifestyle for the rest of your retirement, so it does need to be sufficient to help you do that. Okay, thanks, Donna. Okay, now if you do choose to reduce your hours or salary within a final salary scheme, then if you're reducing your hours, then you're reducing the amount of pensionable service you build up each year. So it is important to bear in mind that that can have an impact on the calculation. Reducing your hours now doesn't affect your previous year's service that you've built up, but it'll affect the ones going forward. But if you reduce your rate of pay, so your full-time equivalent salary, that will affect your previous pension that you've built up. Because of that definition that they use, they look at the definition of your final salaries towards the end of your career. So it is important to bear in mind that that can have a knock-on impact when you're thinking about doing this. And this is why when we think about reducing our hours, for whatever reason, whether that's menopause, whether that's caring responsibilities, whether that's our health, it is important to think about the impact on our pension when we think about doing this. Because that could then have that knock-on impact later on for your standard of living within retirement. Now, hopefully that's just giving you a bit of understanding about how the NHS scheme works and how the final salary sections, the 95 and 2008 sections, work. What I'm going to do now is pass you back to Donna, who's going to take you through the 2015 section and also thinking about flexible or early retirement.
Thanks, Janice. Okay, so let's have a look at the 2015, also known as CARE. So this is career average revalued earnings, which can be obviously a bit of a mouthful. It's a bit of a technical term, but when you look at the example, hopefully you can see why it's called that and why we're driving at that. So on this particular section of the scheme, you've got an accrual rate of 1/54th. Unlike the final salary scheme, in this scheme, the 1/54th applies to the salary that you earn in the particular year of service within the scheme. So let's have a little bit of a look at that. So if you're in the scheme in the very first year and your earnings are £20,000, for that 1 year of service, you're going to accrue a pension of your salary. So 20,000 divided by 54, that's going to give you an annual pension of £370.37. So that's banked, for want of a better expression. Then you go on to year two. So year two, your salary is the same. Oh, sorry, it's not. Your salary is increased by £500. So what you're going to accrue this year is, again, the 54th, but this time you're getting a 54th of 2,500. So that gives you slightly more pension per annum of £379.63. That's also banked. So this is where the revalued earnings comes into it, because what happens is, when it comes to add up your total pension, what you get is your first year that you banked. So that was a 337, but that's now increased in line with inflation. So it holds its value between year one and the year that you're going to take the benefits from it. So that now increases to 383.33, and then you add on the pension that you've earned in year two, and that gives you a total of 762.96. And obviously that's just an example for 2 years, but that would happen to every single year of care pension that you accrue between the year that you accrue it and the year in which you take benefits from it. So how that looks if you've built up pension over 10 years, it's almost like thinking of it like little building blocks. So here you have each of your individual years of pension, and they are all added up together to give you your total pension at retirement. So, for example, you might have a pension of £5,000 a year, and that's going to be made up of each of the little blocks that you've made. But do bear in mind, all of the years from 1 to 9 will be increased in line with inflation if you're taking your benefits in year 10. Now, depending on your individual circumstances, some people will have a higher pension under the care scheme than they would have done under the final salary schemes. And again, you have the option to give up some of your tax-free cash at retirement to get a lump sum payment. So when we're saying that you may have a higher pension within the care scheme here, what we're referring to is going back to what Janice was talking about before, the McLeod judgment. Again, a comparison will be done at the time of your retirement to figure out which section you would have been better off in. It isn't, however, a given that you would have been better off in the legacy sections of the scheme. You might be better off in the care scheme, but obviously you will have the option of both of them, and you can look at that nearer the time. So what if you want to reduce your hours or your salary in the 2015 section? So what happens is, and I mean, we've had a question in the chat box before, so this is pretty much the same thing. So what we're talking about is the hours that you're working. So potentially whether you're working less than what's considered full-time hours or more. So if you reduce your hours or take lower pay, you're going to build up less pension in that particular year based on the amount of your salary. It doesn't affect the previous years that you've built up. So, for example, if we look at the little building blocks again here, if you've been if you've been working full-time hours between years 1 and 6 in purple here, they will remain the same. If you then reduce your hours, it will affect the benefits that you accrue from each year going forward. So 7 there through to 10. Conversely, the same applies. If you wanted to increase your hours, exactly the same would happen. So in the years that you go forward, if we just do it the opposite way around here, from years 7 to 10, you would increase the benefits that you earn in that year. It wouldn't, however, have an impact on the previous years under the care scheme. It may, however, also have effect on the legacy sections of the scheme, so the 95 and 2008, if you've got benefits in that scheme. So if we just look at the little example here, if you've earned 15,000 a year, you'd build up 278 of pension each year and have a lower pension at retirement if you'd remained earning a higher salary. Also, conversely, remember that if you change your salary in the 2015 scheme and you've got legacy benefits in the 95 section and the 2008 section, that can affect those benefits as well, because the final salary link remains until when you leave actual employment. The flexible retirement, how does that work? You've got lots and lots of options under the NHS scheme. So the first thing you can do is step down. So we were talking about this earlier. You could go down to a lower level role or reduce your responsibilities. What we've just been looking at before, you can reduce your hours or days, although do bear in mind, obviously, the effects that we've just been talking about. You can retire and return. So if you take your pension after reaching at least 55 and return to NHS employment, members of the 2008 and 2015 schemes would be able to continue to pay into the 2015 section of the NHS scheme. Members of the 1995 section would not. You can do drawdown. So this is for people who've got membership within the 2008 and 2015 sections only. So if you do drawdown, what you can do is you can take between 20% and 80% of your pension benefits whilst you're still working and continue to build up future benefits in the pension scheme. You can only do this, though, if your pay is reduced by at least 10%. You can, of course, take full early retirement, which means finishing work altogether and taking your retirement benefits. Or if you wanted to, you can continue to work later and take late retirement. So let's have a look at early retirement. As I was saying earlier, it is very tempting, I'm sure, to take benefits early if you can do. But again, it is an irreversible decision. And what you would want to do most certainly is compare the difference between your early retirement benefits and the benefits that you would get if you continued to your normal retirement age, because you are likely to find it's quite a significant difference. And obviously, the earlier you go, the bigger the reduction is going to be. So let's have a look at somebody from the 1995 section. So this is where they have a normal pension age of age 60. So what we're going to look at is Lisa, she's going to take normal retirement, and she's been in the scheme for 25 years at this time, and her final salary is going to be £40,000 a year. So the calculation of what she would get is she goes at normal pension age is going to be 25 years times 40,000 divided by 80, which is the accrual rate. That's going to give her a pension of 12,500 a year. Now, if she decides to go early at age 55, firstly, she's got 5 years less service. So now the calculation is going to be 20 years times 40,000 and 8 divided by 80 again, which is the accrual rate. However, this pension is now going to be actuarially reduced. So there's an early retirement factor applied to it to compensate for the fact that it's going to be paid for five years more than it would have been had she have left it till normal pension age. And that gives a reduction, which brings the pension down to £8,000 a year. And that, of course, is the pension that she's going to remain on, excuse me, for the rest of her days. So as you can see, in that example, it's a £4,500 difference, and that's a permanent change. So as I was saying before, the reduction is significant, and you should consider it very, very carefully before you take early retirement. So what else do you need to think about? And again, we're looking specifically at symptoms of menopause here. Of course, if necessary, you may need to take sick leave. It might be possible to take a career break. You would obviously need to speak to your HR department about that. You would also want to think about the impact it would have on your pensionable service if you take a career break. Or you could potentially take a temporary role or have adjustments to your current role without having to do anything permanently. Again, you would need to speak to HR about that. What would your pension options be if you decided to leave the NHS altogether? I mean, the first thing to say is that when Janice was referring earlier to defined benefit schemes as being the gold standard, for that very reason, it's very unusual to find a defined benefit scheme that you can still join and still build up benefits in the private sector. Not impossible, extremely rare. However, most defined benefits are now exclusive to the public sector. So if you left the NHS, more likely than not, you're going to find yourself in a defined contribution scheme, which again is what Janice was talking about earlier. And if you recall with this, what you're doing is you're building up a pot of money, and what you do with that pot of money at when you come to take benefits from it is entirely up to you. It may or may not, depending on the options that you go for, pay you a guaranteed income for life though. So it is a fundamental change which needs to be thought about very carefully. And of course, you might want to consider paying more into your pension to compensate for the fact that you might want to reduce your hours, or indeed if you want to take early retirement. So contribution rate changes. Contribution rates are going to, they changed on the 1st of October 2020, and they're going to change again at some stage in 2023. Some people's rates have gone up, some people's have gone down. Obviously, because of that, your take-home pay might be affected. Also, previous contribution rates were based on whole-time equivalent pay, where new contribution rates will be based on actual pensionable pay. Contribution rate bands are going to increase in line with salary increases, so an annual pay award is not going to move you into a higher band. Employer contributions will remain the same, however, at 20.6%, which, if you consider that the statutory minimum for an automatic enrolment scheme, which is usually a defined contribution scheme, is 3%. So you can see how generous that employer contribution is. The amount of pension that you're going to build up, however, is not going to be affected. So all of the slides that we looked at previously with those calculations will tell you what your pension is going to be. And as stated before, that is not going to be affected by the change in contribution rates. And then I'll hand you back to Janice to finish off.
Thanks, Donna. So yes, we're going to look at something that we don't particularly like to think about, but is is very, very important to think about. And that's thinking about what happens to your pension benefits when you pass away. Now, we're going to focus on the 2015 scheme, but it is important to note that the benefits that you may hold within the 95 and 2008 sections can be passed on to beneficiaries, but might work slightly differently to the benefits you hold within the 2015 section. So it is a good idea to have a look at the website or have a word with the NHS administrators with regards to how benefits in those two sections would be passed on to beneficiaries. Now, if we just have a look at the 2015 section, as I said, if you were to pass away whilst you were still in active service, so that means that you're actively working for the NHS and paying into the pension scheme, then your beneficiaries would receive a lump sum death benefit of 2 times your earnings. If you've got at least 2 years service, they would also get a dependent's pension, plus a short-term pension, which is equal to your pensionable earnings for 6 months. Now, this would normally be paid to a spouse, registered civil partner, or qualified nominating partner. If you're in a situation where none of those are applicable to your situation, you can nominate another family member. It could be a child or children. It could be a completely different type of family member. But it is important that if that's the situation, that you do let the NHS administrators know what where you would like that money to go. So you can see in the green box that you can fill a form in that will nominate either a different family member to receive your death benefits or to register a non-legal partner. And that is really important to do, because once you pass away, your partner or family members are going to be very, very upset, and it's going to be a very stressful time for them. So anything that we can do now to help relieve some of that stress for them is going to be so important. So please do consider just not sorting those nomination forms out. And the same goes for any pensions that you've got. The NHS is no different. If you do have other pensions, because maybe you've worked elsewhere before the NHS, do check with their pension providers to see whether or not you've done those nomination forms. Okay, Donna. Okay, so we mentioned that you could pay more money into the NHS pension scheme. Now, there is actually 3 ways in which you can do this. So the first way in the purple box is that you can buy additional pension. So this is basically where you're buying a set amount of additional pension, and it's a flexible way of increasing your benefits. So you can buy that set amount either as a lump sum or by making regular payments, and the minimum amount that you can buy is £250 per year, and the maximum in the 2015 scheme is £6,500 a year. Now, that additional pension will then increase by the revaluation orders and be protected against inflation by being index linked as well. And if you wanted to, you could also choose to have the additional pension not only for you, but to provide benefits for your dependents as well if you wished. If you didn't, you could just have it to provide benefits for yourself. So that's the first way you could buy additional pension within the NHS. And you can see at the bottom of the purple box, there is a link to the NHS website that has more information about that. Now, the second way is something I mentioned when I was explaining the difference between defined benefit and defined contribution schemes, which was money purchase additional voluntary contributions, the AVCs. Now, as I said, that's a pot of money that's been invested. You can pay either lump sums or regular amounts. And there are a couple of different providers that you could use. You can see there either Standard Life or Prudential. So you could choose to use one or more of those providers. And what you're doing with AVCs is you're building up a separate pot from your main scheme benefits. And that separate pot then gives you the ability to take 25% of that pot as a tax-free lump sum, and then look to the range of flexible options that are available with defined contribution schemes. So that could be another way of helping to build money towards your retirement. And again, there's a link at the bottom of the yellow box to the NHS website where you'll get more information about that. Now, The last way that you can help increase your benefits within the NHS scheme is known as the Early Retirement Reduction Buyout, or ERRBO. Now, this is only available to the 2015 section. And this is where you're paying extra contributions to buy out some of the reduction that would otherwise apply if you claim your benefits before your normal retirement age. So let's just say that your state pension age is 68 and therefore your normal retirement age of the 2015 section is 68. But say you know that you're going to want to retire at 65 and you don't want to have that reduction being applied to your benefits between 65 and 68. What you can do is pay extra contributions to buy out that reduction that would normally apply from 65. If you take your benefits from 65, where your non-retirement age is 68. Now, you can only buy out up to 3 years worth of reduction. And you can't go any earlier than 65 and reduce that reduction below 65. So it's something that you do need to think about, but it can be a way of helping you be able to go that little bit earlier without having as much reduction being applied. Again, there is information at the bottom of the green box with regards to how that will work. Now, if you don't mind, Donna, thank you. Now, as Donna says at the very start of the call, pension scams is something that is quite prevalent out there. And it's something that we do all need to be aware of and know what to look for. And they are designed to try and take your pension money by being very realistic and convincing. Now, they do this in a multitude of different ways. But it is important to remember that if anybody is contacting you out of the blue about your pension, that is actually illegal. And we do ask that you report it to the Information Commissioner's Office. Now, what they do in the background is they build up information about when this is happening. And the more information they can build up about this being done, the better chance they're going to have in the background of being able to stop that. So it is important to report this if you do find this happening. Now, other signs that a company that's contacting you may be a scam company is things where they're applying pressure to you to make a quick decision. So they're not giving you a chance to think about it. They're guaranteeing you high investment returns. Nobody can guarantee high investment returns. We don't know what the financial market is going to do. So how can anybody do things like that? If you're under the age of 55 and somebody says to you they can help you access it before 55, again, that's a sign it could be a scam. In most cases, you can access your pension before 55. There's very few exceptions to that. One is ill health grounds. So if you have to give up work because of your health, then yes, you may be able to access your pension before 55. And the other one is if you've got what's called a protected pension age. You saw with the 95 section that there are some people, if they started the scheme before 2006, that they may be able to take their benefits from the age of 50. There are sometimes things like that built into pension schemes where, yes, you may be able to access it from earlier than 55, but it has to be a rule within the scheme that allows you to do that. So anybody that's helping you access your pension before 55, they are possibly a scam. The key message to take from scams is that if it sounds too good to be true, it usually is. So please do just be aware of that. Okay, Donna? Thank you. Now, what could you do off the back of this presentation? Well, there's a few things you could do. One of them is to check your state pension. It's really important to keep up to date with what your state pension looks like to make sure that there isn't any gaps in your national insurance record that may have an impact on the amount of state pension that you'll get. You can see there in the green box on the top row, that's a link to the gov.uk website where you can get access to that. So please do go and double check that to make sure you're on track. If you've had pensions in the past that you've lost track of, please feel free to use the government's tracing service. It is a free service. You shouldn't have to pay anybody to help you trace your pensions. So do go and have a look at that. Now, unfortunately, at the moment, there isn't a system where you can pop your national insurance number in and it'll just tell you all the pension schemes that you've been in. it is something they're working on, but it's not something that's available at the moment. So in order to trace lost pensions, it may take a little bit of detective work. So for anyone who's always had a Nancy Drew feel and wants to have a go at that, then that could be a way of utilising your Nancy Drew aspects. It is also important to understand the types of pensions that you've got. Have a look at any old pensions that you've got. Find out if they are defined benefit or defined contribution. What do they offer you in terms of benefits? If you aren't sure, then you can contact us to help you understand them. That's absolutely fine. Another thing that's important to do is to think about what you want your retirement to look like. So have a look at our pension calculator, have a look at the Retirement Living Standards website. Think about what your finances look like and how they might change once you get to retirement. So things like paying off the mortgage, that can have a big impact on the amount of money that you'll have and therefore may not need as much of in retirement. So budget planning can again be another important point. Also make sure that any pension schemes that you've got, not just the NHS, but any of them, all your nomination forms are done and kept up to date so that if anything does happen to you, the providers know who you would like to leave that money to. Okay. So if you do find that you have got any questions, then please do feel free to come and speak to us. We're more than happy to answer questions for you. So we've got 3 different ways that you can contact us. The first is our pension guidance helpline, and that is there to answer questions on any types of pension. So you can give them a call between Monday to Friday, 9 till 5, and pop them to the test. They're more than happy for you to do that. You can also get them on web chat, and that's open between Monday to Friday, 9 till 6:15. If you do have any defined contribution pensions, so say for instance you have the money purchase AVCs, or you've worked within the private sector and you've got a defined contribution scheme from there, or you've got an old private scheme that you set up, and you're over the age of 50, then you could come and have a word with our colleagues on the Pension Wise service, and they will help talk you through the options that you have available with the defined contribution styles of schemes. So you can see there's a number. If you find that you've got any queries with regards to money in general, so things like debt, savings, mortgages, if you're just concerned about money in general, then please do give our colleagues on the money guidance side a call or use their web chat service. They are there to help you with any of those changes and just to help you understand how those things may affect you. And if Donna just moves the slide on one, you'll see there that's a list of the types of things that Money Helper can help people with. So you can see there's quite a wide range of things that we will do our best to help you with. So please do feel free to come and have a word with us. Now that is everything from us. So I have seen that there has been questions as we've been doing the presentation, and I think Donna has answered all of them as we've gone through. But if there are any other questions that anybody would like to ask, then please do feel free.
Thanks, Jane.